Every supply and demand zone on your chart is a line where two traders look at the exact same price and feel opposite things. One is convinced it is about to fall apart and sells. The other reads the same structure, stays calm, and prepares to buy. The difference between them is not the indicator, it is which side of that emotional split they are standing on. In this video, we treat supply and demand not as a simple support and resistance strategy, but as a structured execution model built on real order flow and market behavior. So you learn what these zones represent, how they influence price, and how to mark them correctly within the key trading concepts of the stock market. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before a single zone can mean anything, you have to see what is really moving price. In the market, every price movement is driven by the balance between buyers and sellers. When demand is greater than supply, price moves up because buyers are willing to pay higher prices. When supply is greater than demand, price moves down because sellers are willing to accept lower prices. So what exactly are supply and demand zones on a chart? A demand zone is an area where buyers previously stepped in with strength and drove price upward. In contrast, a supply zone is where sellers entered aggressively and pushed price downward. These areas matter because the market often reacts to places where strong buying or selling occurred before. When price returns to a supply zone, sellers may become active again, increasing the probability of another move lower. Likewise, when price revisits a demand zone, buyers may re-enter the market and push price higher. In simple terms, demand zones function as potential support, while supply zones act as potential resistance. They highlight areas where price is more likely to react instead of moving randomly. And this is where the psychology starts. A zone is really a memory, the exact place where one side of the market was overwhelmed. When price returns, most traders feel that memory before they read the chart. The crowd that got trapped in the last move sees a threat and rushes to exit, while smart money sees the same level as an imbalance, likely to repeat, and quietly takes the other side. Your job is not to feel the level, but to read who is trapped there. However, the key is to focus on zones formed by strong, decisive buying or selling, not slow and sideways price action. High-quality zones are typically created by impulsive moves that reveal a clear imbalance between buyers and sellers. To make this more objective, we need clear criteria. For example, we can require 3 strong green momentum candles to classify an area as a demand zone. In the same way, 3 consecutive red candles with large bodies and a strong push downward can define a supply zone. The idea here is simple. We want evidence of real participation and strong interest, not just small, random fluctuations in price. Now that we understand that, the next question is how to correctly mark the supply and demand zone on the chart. Traders may use slightly different techniques, but one principle remains the same. We focus on the area where the impulsive move actually began. Identifying that starting point depends on how the candle is formed. So let us walk through a few common ways to mark these zones, clearly and consistently. Here, for instance, we see the most recent impulsive move to the upside. This strong green candle is the origin of that expansion. Because the decision to push price higher happened during this candle, we mark its range as the demand zone. When price eventually comes back into this area, we anticipate some form of reaction within that zone. Another widely used approach is to mark the last red candle before the bullish expansion. This candle represents the final selling pressure before buyers took control. Once price breaks above that prior supply, the area effectively shifts into demand. So when price revisits this zone, we expect buyers to respond again, potentially leading either to a rejection or a continuation to the upside. In this specific example, the choice of candle is not critical because both candles cover nearly the same price area. However, that is not always the case. In some situations, the candlestick structure clearly determines which zone is more valid. For instance, if we mark only the first red candle as the start of the bearish move, the zone becomes very small and may not accurately represent true supply. In this case, marking the last green candle before the drop provides a broader and more meaningful supply area. On the other hand, there are situations where the first red candle offers a cleaner and more reliable supply zone. It all depends on how the move unfolds and how price behaves afterward. The structure of the expansion and the reaction that follows will often guide you toward the better choice. Another key element to consider is the wick. In this example, the demand zone is drawn from the wick because that is where price was strongly rejected and the impulsive move actually began. The expansion did not originate from the first green candle or from the previous red candle. It started at the lowest point of the wick, which defines our demand zone. Wicks are powerful price action signals because they reveal areas where the market rejected lower or higher prices with strength. When we mark these levels properly, we increase the probability of a future reaction if price returns to that zone. With all of that in mind, here is an essential reminder. No matter how precise your supply and demand zone is, a perfect rejection from that exact level is never guaranteed. Sometimes price reverses before reaching the zone, and in other cases, it retraces deeper than expected before reacting. Notice the quiet trap inside that reminder. The need for a perfect line is really the need to feel in control, and that feeling is what makes traders freeze or over-adjust their zones. Precision bias whispers that one more refinement will remove the risk. It never does. A zone is a region where reaction is probable, not a promise. And trading it well means acting on probability instead of chasing certainty. So the next logical question is this: how do we avoid missing trades and unnecessary stop-loss hunts? One practical way to reduce missed entries is to place your order slightly above the beginning of the demand zone, by about the size of the spread. That way, even if price only taps the very edge of the zone and quickly rejects, your buy limit can still be triggered. To reduce the risk of stop-loss hunts, you also need to adjust your stop placement according to the size of the zone. If the demand zone is small, give your stop a bit more breathing room below it. If the zone is larger, a more balanced approach is to enter closer to the middle of the zone and place your stop safely below the entire area. There is emotion buried in that stop too. Placing it tight, right under the zone, feels safe, but it usually comes from loss aversion, the urge to lose as little as possible if you turn out to be wrong. The problem is that a stop set by fear sits exactly where the market likes to hunt it. Sizing it to the structure of the zone instead of to your discomfort is what keeps you in the trades that were always going to work. Up to this point, we have covered what supply and demand zones are, the psychology behind them, and how to mark them correctly on the chart. Now we move to the most practical part of all: how to actually trade these zones in a structured way. We will go through two straightforward strategies. The first one uses a single time frame, and the second combines two time frames for additional confirmation. Let us start with the single time frame supply and demand entry. This approach follows a clear and simple sequence of steps. It can be applied to any market and on any time frame. The first step is always to identify the overall market direction, because trading in alignment with the trend increases probability. So let us begin with a quick and practical way to determine that direction. When price creates a clear 1, 2, 3 pattern and then breaks out, that structure defines a trend. If price continues by breaking above the most recent swing high, it confirms continuation. As long as price remains above the latest protected swing low, the market stays in an uptrend, and our bias remains bullish. If another breakout occurs to the upside, we then mark the lowest point that led to that breakout as the new protected swing low. And again, as long as price respects that level, we continue looking for buying opportunities. However, if price breaks and closes below the protected swing low, that signals a change of character. In simple terms, buyers failed to maintain control of the structure, and sellers are beginning to take over. That shift suggests a potential reversal. From that point forward, we can shift our focus to identifying fresh supply zones and preparing for possible short positions. That change of character is a psychological event, as much as a technical one. When the protected swing low finally breaks, the structure has already told its story. But the crowd keeps holding the bullish version, because letting go means admitting they were wrong. Cognitive dissonance keeps them long into the reversal. The disciplined trader flips with the structure the moment it shifts, not when the pain finally forces it. Once direction is clear, step 2 is to mark supply or demand zones according to the rules we covered earlier. In this example, the market direction is bullish, so we focus only on demand zones and buy setups. Mark the most recent valid demand zone, place a buy limit at the beginning of that zone, and position your stop loss below it. If the stop is also below the protected swing low, that is even better, as it typically provides stronger structural protection. For take profit, aim for the next significant level in front of price. But before finalizing the trade, pause and evaluate one critical factor. How much room does price actually have before reaching the next key level on the higher time frame? For example, in this scenario, imagine we zoom out to a higher time frame and notice that price still has significant space before reaching the next major level. In that case, entering the trade makes logical sense because there is room for price to move. Now consider the opposite situation. If price has just tapped into a strong higher time frame resistance area with clear reversal potential, taking a buy trade becomes much riskier. In that environment, it is usually wiser to wait for confirmation, or shift your focus to possible selling opportunities instead of forcing a long position. This single question, how much room is left, is where good setups quietly go wrong. A clean zone creates tunnel vision, and the excitement of a valid entry hides the ceiling sitting right above it. That is FOMO wearing the mask of analysis. Zooming out to ask what stands in price's way is the unglamorous habit that separates a patient entry from a crowded one. So that covers the first strategy. It is clean, straightforward, and effective, relying on a single time frame. Now let us build on that foundation and move to strategy number 2, where we combine 2 time frames to increase precision. On the higher time frame, we follow the exact same principles we discussed earlier. The only difference is that we refine our execution by dropping down to a lower time frame for confirmation and entry. This approach can be applied to any market and does not depend on a specific time frame. The key rule is simple. Your execution time frame should be roughly 2 steps lower than your higher time frame. Here are a few practical combinations based on trading style. For instance, if your higher time frame is the 4-hour chart, you can drop down to the 15-minute chart for execution. Now let me walk you through how this works in practice. The first step is to identify the overall trend and mark the relevant supply and demand zones on your chart. At the same time, analyze the higher time frame structure to measure how much room price has before reaching the next key level. This helps you avoid entering trades with limited potential. Next, be patient and wait for price to retrace into your selected zone. Do not enter prematurely. The market frequently sweeps early entries and uses them as liquidity before making the real move. So the rule is simple. Let price reach your demand or supply zone first. Once price taps into the supply zone, shift to the lower time frame to look for confirmation before entering a short position. On this lower time frame, you may notice a clear uptrend, which represents the corrective move within the higher time frame structure. What we want to observe is a loss of strength inside the supply zone. In practical terms, we look for signs of rejection, or evidence that the lower time frame uptrend is beginning to weaken. There are several valid triggers you can use for confirmation, such as a strong wick rejection, a break of a trend line, or even a change of character. In this particular example, however, we are looking for a liquidity grab inside the supply zone. A bearish liquidity grab happens when price briefly breaks above a previous high, but quickly returns back into the range. This tells us that buyers failed to sustain the breakout, and the move was likely a trap. At the same time, liquidity resting above the swing high has been swept. After this type of behavior, the probability often shifts toward a stronger move to the downside. In the same way, a bullish liquidity grab forms when price breaks below a previous low, but quickly moves back inside the range. This behavior shows that sellers were unable to sustain the move lower, and the market immediately rejects those lower prices. As a result, liquidity resting below the swing low is taken, and momentum begins to shift in favor of buyers. When this sweep happens inside a higher time frame demand zone, the probability of a stronger move to the upside increases. Both bearish and bullish liquidity sweeps tend to be more reliable when they occur within higher time frame supply or demand zones. That higher time frame context adds weight to the setup and filters out weaker signals. The liquidity grab is the clearest picture of the crowd standing on the wrong side. Everyone rests their stops at the same obvious high or low, and that cluster becomes the target. When price sweeps it, the traders who were just stopped out feel certain the breakout is real, right as it fails. Herding builds the trap, and the sweep springs it, so smart money enters exactly where the crowd was forced out. So how do we execute the trade using this approach? Start by drawing a line from the tip of the wick at the most recent swing point. If price pushes beyond that level, takes the liquidity, and then closes back inside the range, that close becomes your confirmation. At that moment, you can enter the short position, place your stop loss above the swing high, and aim for the next significant level ahead of price as your target. And above all, remember that context and patience matter. Focus only on high-quality setups, control your risk carefully, and never force a trade. When you apply these principles consistently, supply and demand trading can become a structured and reliable part of your overall strategy. And this is the hardest discipline of all, because doing nothing feels like failing. Action bias insists that a real trader is always in a position, always doing something. But the edge here is built in the waiting, letting price come to your level instead of chasing it to feel productive. The trades you skip protect the account as much as the ones you take. So here is the single thread running through everything we covered. Every zone, every stop, every liquidity sweep is a place where the crowd feels one thing and the structure says another. Supply and demand trading is not about drawing random zones and hoping for a reaction. It is about standing on the discipline side of that emotional split. When you combine clear zone identification with trend alignment and disciplined risk management, you stop reacting like the trap side of the market and start executing with logic. Stay patient, focus on quality setups, and let the market come to your levels to build consistency over time. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.